think there's a number of people, a number of programs out there that lead you to believe that there's an easy button to raising money online. And it just doesn't work. I mean, yeah, they sell a lot of programs, but their success isn't really there because you have to be able to raise money one-on-one first. Raise $500,000, okay, at a minimum, and then you can get online. And if you don't commit to content, you can't actually build trust with people. Though you'll get their email address, but they're never going to invest with you.
It's interesting because that's kind of where we're at in our business right now is, have the ability to raise $3 to $7 million a year. But like, if we want to scale and really grow to that next level and start doing 8 figures plus, I have to start spending much more of my time on the content and the email marketing and all of that. What's going on, everybody? Welcome back to the Multifamily Wealth Podcast. In this episode, I'm interviewing Michael Blanc, who is one of the OGs of the online multifamily investor content creation, kind of education space. He's somebody whose podcast I listened to when I got into the business back in 2016. And he's somebody who has released a ton of content around multifamily investing over the last 10 plus years. I believe he started his podcast in 2014, and I think he was creating content before that. But somebody who is really a household name, I think, if you've been around multifamily for any reasonable amount of time, few years plus, whether it's his podcast, whether it's his book, whether it's just all of the content that he creates. I think a lot of people are familiar with Michael Blanc, and I think a lot of people can learn something from him and his approach as it relates to growing their online brands and platform and how to translate that into raising capital, deal flow, etc. So in this episode, we talk about his backstory, and he's certainly got an interesting backstory where he owned a bunch of restaurant franchises that went belly up, or I shouldn't say belly up, but struggled in 2008 that he inevitably had to sell. And that's how I ended up getting into the real estate business. And we talk about what's changed in the marketplace over the last 10 years as he's grown his portfolio. We spent some time talking about how he asset manages all of his different deals with a handful of different joint venture partners throughout different markets. And we spend a good chunk of this show talking about how to build your presence so that you can actually start raising capital from LPs and actually building out your base of investors in the early days as you start trying to grow the base to grow or to raise that first 500 grand, 600 grand, $1 million. Get into a little current events related stuff as well as it relates to what he sees happening in the market over the next 12 months, what they're focusing on in his business. But I think this is a really good episode for folks out there who are looking to further develop their platform, their presence, their brand, etc. Which, if you're somebody who's looking to just raise money to buy real estate deals, or you want to more drastically increase your deal flow, that's just step one in the process, is you need to become more known. You need to become more top of mind, and you have to build some level of a presence online to make that a scalable endeavor over a period of time. So that's what we get into in the later part of this episode, as I mentioned, but we also touch on a bunch of different other topics that I think are going to be really helpful as well for folks who are looking to grow their multifamily portfolio. All right, I am here with Mr. Michael Blanc, one of the OGs, I would say, of the multifamily investing space, from a content standpoint, from an online brand development standpoint, and somebody who's just been actively investing in multifamily for a very long time now. And someone whose podcast I listened to as I got into the business and as I started to try to get my arms around the process of buying mid to large multifamily properties at the time, trying to scale up from the small deals. Michael's podcast was one that I listened to a bunch and still do tune in nowadays, as I'm sure you heard me mentioning in the show intro here. But Michael, it's a pleasure to have you on the show. Why don't we start with your background, how you got into real estate, kind of the spark notes there, and maybe share a little bit more about what your business looks like today.
Yeah, maybe like so many listeners are watching similar. I was taught to go to school, get the best grades I could, get a job with benefits, which I did. And I actually have a computer science background, highly educated, Axel, which I then threw away. But at first, I spent a couple of years at AOL, America Online, back in the mid-'90s, and joined a software startup in '97 called Web Methods, which went public 3 years later, and put a bunch of money in my pocket. And I coasted along because and then I read Rich Dad Poor Dad in 2004, and that threw me for a loop. Like, I was confused for like 3 months straight, and finally came home to my wife and declared that I had quit my job. And she's like, "Oh, well, I said, okay, what's the plan?" I said, "I don't have one, but we have a bunch of money. So what can possibly go wrong?" And I just felt compelled to get me some financial freedom. So I just studied and did as many things as I could to learn how money works. I traded stocks and options. I took a commercial real estate investing class. I flipped a couple houses for good measure. But my big idea of financial freedom was to get into the restaurant franchise business. That's obviously what everyone else would have done in my shoes as well. And it did work well for a little while until the recession hit, and it really stopped working. In fact, it got so bad, I'll make a long story very short. I subsequently lost my IPO millions in my restaurant experience. I had 8 restaurants at the time. I had the dubious reputation of being the biggest franchisee in the franchise. Yay me. And ended up having to run 6 restaurants myself, trying to sell it, which took much longer than I thought. No one wanted to buy money-losing restaurants after the recession. And I tried to dig myself out by flipping houses. So I flipped a couple in 2006 and 7, right before the recession. So I didn't hold anything afterwards. Thankfully, I only had 6 restaurants, which was bad enough. And then try to flip my way out of it. So I started using hard money and borrowing money from private lenders. And then in 2011, I kind of accidentally got into an apartment building, a 12-unit in Washington, D.C. One of my wholesalers brought it to me. And that was a nightmare for the first 18 months. We'll talk about that later. I immediately regretted getting into apartment buildings. Finally, after 18 months, I stabilized the daggone thing. And then it started sending me mailbox money, the thing that you read about. Meanwhile, I'm flipping, which is not very passive at all. And that's when the light bulb went off. After 3 dozen flips, I went, maybe I should do more of that and less of this. And that's when I started pivoting, and that's when I started blogging around it. So I started creating content and training. And so today we're one of the leading authorities on helping people get into the business by raising capital. So the mission really is financial freedom with real estate, but it's not the way most people think, which is with flipping and rentals.
Yeah, no, 100%. I mean, flipping houses is a glorified high income job, assuming that it's going well. And at worst, it's a high stress money losing job if it's not going well, right? I mean, I think a lot of folks who get into multifamily specifically or end up acquiring rentals, kind of starts through that lens. I mean, that's how I did. Granted, I was flipping small multifamily properties because those were the deals I was finding at the time when I got into this back in 2016, 9 years ago or so. But very quickly realized that that's not a long-term solution as it relates to replacing your income or building some type of, long-term wealth creation, because it's not tax advantaged. And when you stop working, the money stops coming in. So I think a lot of people who are listening have probably had that same realization. I do want to talk about that first deal that you mentioned. You mentioned 12 units, had some pain, 18 months of some struggle there. I'm sure you've probably had a handful of things you learned on that one, but what are a couple of the big ones that you still think about today?
Yeah, I think first and foremost, I wasn't working with a team around me. I didn't have any advisors around me. Like if I had advisors around me, if I had taken the time to ask, hey, someone who's actually bought apartments in DC, they probably would advise me not to buy in DC and maybe go to Maryland or anywhere else but DC. Forget about that. Pro-tenant law, who cares about that? And then had I insisted on buying in DC, they would advise me to check the legal records of each tenant while doing due diligence, which I didn't do either. Then discovered after closing that one of them was a professional tenant who had been suing, not paying rent for years, and suing the previous owner, which then he continued doing with me afterwards. That created all kinds of problems. And it was compounded, again, because I hired the wrong kind of property manager, which an advisor would have told me, Michael, this is Section 8 property. You might want to hire a property manager who knows about Section 8 properties, which I didn't do. And so it compounded the whole effect. And it was pretty much an awful mess. I think more things went wrong in that deal than all of my other deals, 27 deals combined since then.
Yeah, well, that's how it always goes in that first one, right? It's at some point you have to take some action, and even if you educate yourself to the umpteenth degree, right, there's still going to be something that you learn on that first deal or the first couple of deals. I want to highlight your point there around working with a management company where their portfolio is comprised of buildings that you already own or that you're going to be bringing to them, or the property that you're going to be bringing to them, because that's a mistake that I've certainly made a couple of times when going into new markets, is working with a third party where they primarily manage newer, B class, A class properties. I'm bringing them something that's C class, a little bit older, and there's just a misalignment there in terms of just the amount of management required there. They don't have the team set up to adequately manage it. And there's oftentimes a bit of a growing pain if you're taking a property to a management company that doesn't typically manage that type of property. So, I mean, that's one that I've made, and I'm highlighting that for all the folks listening. Now, obviously a lot's happened from that first deal to now, right? And there's, I think you mentioned 27 deals, and there's a bunch of time that's passed, and I'm sure plenty of things have changed in your business. I'm going to, maybe ask at a high level, and then we can drill down. Key events kind of throughout that trajectory. And when I say key events, a couple of examples, right? Maybe when you started buying in another market, or maybe when you started raising capital. Like, what were some of the inflection points that allowed you to start more rapidly growing your business along the way? And, just looking retroactively over the last 10 plus years, some of the more important kind of milestones that were hit and why they were important in terms of as you've grown over the last decade.
Yeah, I think one of the milestones was, bringing on joint venture partners. And in fact,
Mhm.
people on our ecosystem, almost 100% of them actually joint venture with each other. And it's something I didn't discover until a little later on. I did joint venture with people in our community would bring me deals and I would raise the money for it. These were smaller deals. I remember in 2019, 2018, we bought a $1.6 million in Birmingham, needed to raise $650,000. I had a list at the time and I was online and blah, 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 but I barely could raise a 650,000. And, a year later, we raised $3.2 million, but it was through a joint venture partner. And so I raised my share of it, but the partner raised more than I did because he had access to a lot of capital. What he didn't have was deal flow. And so we were able to take down a 321 unit in Memphis because of that. And that's amazing, right? Where you can take down a deal that size. And this whole idea of joint venturing with people really allows people to scale faster. I think that's probably number one. And then number two is really one of the mistakes I made early on is because I was joint venturing with people in my community, I went wherever the deal was, which gave me great deal flow, but it was all over the place, geographically all over the place, which made management very, very difficult. And so as you're trying to scale a company, the operations or the asset management becomes very important. Unlike house flipping, when you essentially, you make your money when you buy, right? With this business, you only make money when you execute the plan. Because if you don't execute the plan, you're not making any money. You're going to be in the hole. And so operations and asset management becomes more and more important. And so going deep into geography is very important. And then really investing in your operations. Most people really don't want to invest in operations because it's boring. They want to find deals and raise money. That's what they want to do. But at the end of the day, you do need to invest in operations. And so that's something that we learned along the way. If you do want to scale, you got to make sure you're investing in the business. And the third thing, and I think I'm done with the third thing, is if you want to raise more and more money, you got to do it in the right way online, right? And so now you're in the online marketing space. You're not even in a real estate investing space. You literally have to learn content, YouTube, paid ads, video, podcasts. You have to get into leads and leads conversion and things of that nature. So as a real estate investor, if you want to scale, you have to tackle one step at a time. But it is one thing that if you want to go from raising 1 million to 10 million, it's something that you got to get into.
Yeah, and it's a completely different set of challenges to go from being able to raise $0 to $1 million for a deal than it is to go from 1 to 10, because usually 0 to 1, it's you're leveraging your personal network. You can kind of get through with some level of sheer volume of outreach, a little bit of, I'm going to throw it up on LinkedIn if I'm doing, if I got a 506C and I can advertise it, and you can kind of scrape and claw to get it together. But once you go from 1 to 10, unless you have some significant whale investor that's coming in for a very large percentage of that capital, if you're putting it together with a lot of individuals, you are now, as you mentioned, in the online marketing space, which is a completely different business than let's go figure out how to put real estate deals together. Like those are two different worlds, two different sets of challenges, a bunch of different KPIs you got to track, as you mentioned. And it's interesting because that's kind of where we're at in our business right now is, have the ability to raise $3 to $7 million a year. But like, if we want to scale and really grow to that next level and start doing 8 figures plus, I have to start spending much more of my time on the content and the email marketing and all of that, which is, it's not real estate fundamentally. It's not the nuts and bolts of real estate. It's sales and marketing, which is certainly different. I want to go back here a little bit though, because you mentioned some operational challenges as you started to scale and work with a lot of JV partners. You got into a bunch of different markets. I just want to get into your head and start thinking about kind of like your mindset here. So let's say, because there's a lot of people listening to the show that are living in, I live in Boston. A lot of people live in a major city that listen to this, whether it's New York or LA or Boston or DC, and they don't want to buy real estate in their backyard. They know they need to go into, or they want to go into another market to buy real estate. And you're in a position where you have all of these people bringing you deals that are across the country in different markets, and you're trying to evaluate these markets, you're trying to evaluate these opportunities. What's kind of the first step in, I'm trying to understand if this is a market that makes sense, And maybe provide the context of like what you were investing in and what you were looking to buy to give people kind of a better sense.
Yeah, first of all, there's a number of good markets to invest in. So,
Yeah.
in general, you're looking for a market that's growing population and income because a rising tide lifts all boats. But you're also looking for a market where you can buy cash flowing properties. Again, there's a number of them, but some of the cities you mentioned, Boston, New York, whatever, LA, are not one of them, right? They're just too expensive. You can't get them to cash flow. So typically, unless you're doing some kind of other strategy like ground up development or flipping or something like that, typically we're not investing in those markets. You're also looking for states that are pro-business and pro-landlord to a large degree, and therefore disqualifies states like New York, California, and the District of Columbia, for example. Yeah. And there's a lot of variety of markets that are like that. And then the last one really is you got to find a market or markets that are big enough to sustain deal flow, right? So, for example, we love Huntsville. We have a couple of properties. Love Huntsville. It's not a very big market, so there's not a lot of transactions happening there. So I can't build my business reliably because I can't get the deal flow from Huntsville. So I might have to pick another smaller market. Between them, I get more deal flow, or you just go ahead and pick a bigger market.
Yeah. I mean, I think that's important, the deal flow piece of it. And it also has to be contextual to your goals too, as a real estate investor. It's like, if you're looking for more heavily discounted opportunities, less competition, but you're okay with a little bit of a risk, you may want to not look in like a tier one city, like a Tampa, Florida, or like a Miami or something like that, because it's very competitive. Maybe you want to go outside of those areas a little bit and look in some of these smaller areas. And you're okay with the fact that maybe the city is not going to allow you to grow a 3,000 unit portfolio within it, but you want to buy a few hundred units and you're okay with it being a little bit smaller versus somebody who's looking for a little bit less risk on the buy side and they want to participate in a market where there's more management companies and more lenders and all of that. Well, that's also going to be relevant as it relates to picking your market as well. As you started working with all these JV partners, let's talk about the framework from like an operations standpoint. And it may not even have specifically to do with working with JV partners, but working with a number of different management companies in a number of different markets and starting to make sure that you're overseeing all of that well and all of that. I'm sure you built some systems around that. When you take down a deal and you have your third party PM, what is the ongoing asset management process look like for those deals in terms of like what you've built in order to make sure that you're holding all of those PMs accountable in terms of some recurring stuff that you're working on?
Yeah, I mean, you're looking at various KPIs. You have a asset management scorecard. You're looking at various different KPIs depending on where in the stage you are and what you want to tackle. Oftentimes, we try to tackle the income side and try to knock off some of the bigger expense side, but really focusing a lot more on the lease up, on the unit turns and the lease up of those. A lot of property managers really struggle with leasing. They somehow can't answer the phone, or they can't show up when someone comes by and makes an appointment, or they can't sell the unit. They let someone leave without an application. So leasing has always been a kind of a major nightmare for us, for everybody, really. So you have your asset management dashboards that you're looking at. You're shining a light on various different KPIs based on when you are. And this is one challenge when you have different property management companies. Everyone's P&L is different, right? The format. So you got to go in and dig around the P&L, and you got to find the line items. You got to map them all into your asset management. Right. And so that's one challenge there. They have different systems, different processes for certain things. So I think the key really is to try to get scale in a market as quickly as possible. That allows you to reuse the same property management company, same systems. You can start sharing people with each other. And so that really simplifies things. And then really having a cadence of weekly meetings and looking at some of those KPIs on a weekly basis and on a monthly basis. Making the property manager set goals for themselves and holding them accountable to the goals that they have set that's really what asset management is. And then not being, I think one other mistake I see a lot of people make is because they feel like this is a passive investment. It's actually not. It's a highly leveraged investment, but I see a lot of operators, go buy the property once or twice a year, which maybe you can do once it's extremely stabilized and everything's going well. But in the beginning, you got to go by there at least monthly. In 9 days, I would go by more frequently. And so you're building up trust with a property manager and you're getting to know the staff a little bit. So you could be much more effective over Zoom and phone.
Yeah, no, for sure. No, all great tips. I think it's really important, just especially for a lot of the newer listeners who may not be buying a 100-unit property here, but even if you're buying something that's 10 units, 15 units, 20 units, if that's a big jump for you, to have some type of sheet built out that allows you to track your projections versus your actuals and to use that as a collaborative tool to refer back to with your PM company, like kind of just level one of asset management. And I think a lot of people hear a lot of the KPI discussions and a lot of that, and they immediately, for some reason, at least a lot of the folks that I chat with, think about that through the lens of like large multifamily, but it's still a relevant conversation to have, even if you have a smaller property with a management company. It doesn't need to be a maybe a weekly call, because you may not have enough to chat about on a weekly basis, but something to where you're at least consistently coming back to it. And even just being a slightly squeaky wheel with your management company is important, because it makes it so that your property and you as a client are a little bit more top of mind, especially for the folks who are working with a third party management company where they might be a smaller portion of their overall business. And then over time, as you mentioned, right, you start to build out a portfolio in an area with a management company, and that gets a lot easier as you start to grow your relationship with one. All right, so you've been in this for a long time. You've been buying multifamily now for 10 plus years. I'm curious as to how you've seen the market change over the last 10 years. Now, obviously, prices have gone up, and you got the interest rate dynamic, all of that, and there's some current event stuff maybe we'll get to later. But big themes in terms of like overall trends that you've seen over the last 10 years, whether it's competition or markets that have gone in and out of favor or different strategies to growing your business. What are some things that maybe pop out as it relates to how the business has evolved over that period of time?
Yeah, things have constantly changed, of course. I think the biggest mistake that people make is they feel like they want to time the market, which is very, very difficult to do. And a lot of times the market involved kind of behind the scenes. So if you're not in the game, you don't even know about it. And if you do learn about it in the news, it's already passed. Case in point is COVID, right? Like just the way that COVID happened. And, if you're on the outside, it was a disaster. We got eviction moratoriums, people aren't paying. And the truth actually was that people were actually paying, and the ones that didn't pay got subsidized by the government. So our collections went up. We picked up one of our best deals 3-4 months after COVID. And most people were like, oh my gosh, this is bad, right? So trying to time the market is a mistake. The best way to do it is to get into the market and then adjust your tactics, your underwriting, what's currently going on the ground, right? And so, if interest rates are up, then I can underwrite with a higher interest rate. It's not, or LTV, wherever the case may be. I can change my underwriting based on what's going on in the market right now. And you're constantly trying to adjust what's going on to take advantage of what's going on. You're constantly kind of, you're reacting to what's going on and trying to take advantage of what's going on. I think the thing that caught everyone off guard was the rapid rise in interest rates. That's something that no one was able to underwrite. So if you were in the game 2.5 years ago, that may have created some problems for you. If you haven't been in the game, then it's completely moot. It doesn't really matter. What matters now is what's going to happen moving forward. And I do think that right now is probably the best time to buy I've seen in a long time. It reminds me a lot of 2008. Of course, a lot of people now are not buying or invested because they're scared.
Mm. Well, that was going to be a question I had for you too. I know you're in multiple different markets, and obviously there's different dynamics depending on the market you're in as it relates to what the last few years have done to you, right? I mean, we own some real estate down in Florida, but the vast majority of our portfolio is an hour north of Boston up in New Hampshire, and two completely different stories over the last couple of years. Pricing has leveled off in New Hampshire, but we haven't really had any distress whatsoever, and NOIs have still continued to grow. Whereas down in Florida, obviously, between the insurance dynamic, all the supply, rents coming down, it's a totally different set of challenges. And both markets are comparable in that there are some high level themes, but once you really break into it, it's two completely different stories. Is your focus changing over the next 12, 24 months, call it, from an acquisition standpoint? Are you still looking to buy the same things or same types of deals that you have been buying over the last few years? Or has there been any change in your focus as a result of what's happened here since 2022?
No, not yet. We got some ground to make up. We haven't really bought much the last 24 months. So we got some ground to make up. So right now our focus does continue to be multifamily and getting larger, nicer assets. That's kind of where we were 2.5 years ago, nicer, bigger assets, class B plus assets. But I think over time, there may be a case to be made where we turn a little bit more into a private equity company where we are raising capital and we're getting into maybe different asset classes, maybe through joint ventures or maybe even buying companies. I'm not exactly sure yet, but that's more on the horizon. What's really important for us right now is to kind of get back into a little bit more of a growth mode when we kind of collectively been stalled a little bit. So at least for the next 12 months, that's all we're going to be doing.
Gotcha. And what does that focus now look like in terms of if you were to go out there and start trying to and more intentionally source, multifamily deals, trying to grow Southeast markets in terms of where you're looking to buy, just understanding exactly where you guys are looking?
Yeah, so Southeast in general, right? So we're most of our portfolios in Atlanta, but we're again, eye open to other markets in the Southeast because you can still leverage a lot of the resources that we have in this area. And it has been challenging to find deals. You just have to underwrite more deals. So we hired a kind of a junior analyst who can do some of the heavy lifting when you get a marketing packaging, getting into the underwriting software very quickly, and that allows us now to underwrite more deals. And so, a bit of a numbers game.
100%. Yeah. And that makes total sense. And I think there's a lot of folks, especially people who have more of a focus in the Southeast where it's been kind of hit pause last couple of years, or try to develop a deeper sense of where insurance is going or where rates are going or where the market cap rate is going to settle as a result of everything that's happened. At least that's the approach that we started to take as it relates to the Southeastern markets that we were looking in. But I'm going to completely switch gears here because I would be remiss if I didn't at least touch on the fact that, or touch on the topic of you obviously building on a massive platform from an online personal brand standpoint, from, on the education side of the business, everything you've done to grow your presence in the multifamily real estate sector. A lot of the folks listening to this want to start raising money to buy deals. I tell folks oftentimes that step one is you need to figure out, that the high level thought is you need to become more known to your network. You need to be more top of mind. Really easy way to start doing that is creating some content, starting an email list, going to more meetups. Like, you've got to put your face in front of more people if you're going to start raising capital from LPs. And that's really the only way in order to start doing that is to at least start going down that road. Question for you, in early 2025 here, we're recording this early February, it'll be up within the next 3-4 weeks, is what would you recommend to the investor who's done a few deals? They're comfortable with the process of buying multifamily. They got everything figured out from a market selection standpoint. Now they want to start raising money. And they know that they probably got to start doing something to build awareness around themselves and their business. What are some of those first couple of steps you would recommend that they take in order to start, going down that road?
You kind of stepped over step one, which is you said they've done a few deals. I think there's number of people, number of programs out there that lead you to believe that there's an easy button to raising money online. And it just doesn't work. I mean, yeah, they sell a lot of programs, but their success isn't really there because you have to be able to raise money one-on-one first. You have to know what investors are thinking, what they're afraid of, what they want, the questions they're asking. And over time, you want to develop kind of who is your avatar? Who's your ideal investor avatar? Because how can you amplify a message if you don't know what the message is, right? So people think they can just go on Instagram or whatever, and now people will wire them $100,000. It's not the case. So it's unfortunate that it's a little more tedious. You got to raise money one-on-one first, raise $500,000, okay, at a minimum, and then you can get online. And so a lot of people make a variety of mistakes online. They put up a website and then they're surprised that they don't raise any money. It's because they're not building an email list. You got to build an email list. And how do you do that? Why would someone give you their email address? You need a lead magnet. In order to generate a lead magnet, you have to know who your avatar is, right? So you got to put something out there that your avatar is going to want to give you their email address for. And then the other mistake people make is they don't commit to content after that. If you don't commit to content, you can't actually build trust with people. Though you'll get their email address, but they're never going to invest with you. That's what I did with that Birmingham deal. I had a bunch of people on my email list, but I was not producing content for passive investors. I was producing content for active investors, but I wasn't speaking to the passive investors, right? So you got to commit to content. A lot of people don't like that idea. They don't like the activity. They don't like the way they look on video, the way they sound on podcast, And so my advice to people is you have to commit to content and outsource as much as you can. I've never outsourced the creation of the content because it has to be your voice, but you should outsource the production and the distribution of the content so that it doesn't become so tedious. And so this is kind of when you're getting into reinvesting the money you make from the business. At the beginning, I was just like, oh, all this money? Cool. I'm just going to keep and buy more beer with it. But really what we should be doing is trying to figure out what portion should I reinvest in the business to grow my business. And marketing is frankly one of the biggest expenses, aside from hiring a VA, or for example, is how do I invest in that? I'm going to have to build a marketing platform with a lead magnet and some automations with a calendar where people can book a call. Once I have a lead capturing mechanism, now I can generate leads. I can go on podcasts. I can go on social media because now I have a lead magnet. I can say, hey, if you want to know more, download this thing. And now I have your email address. Once you're on the email, you got to produce content. that costs money to hire someone to produce and distribute the content. But that's when you look at, when I call these elite syndicators, people that scale, that's what they're doing. They're investing aggressively in their business, and they tend to invest most aggressively in marketing and in their platform to generate, capture and nurture leads, so that when they do a webinar, they can raise millions in days.
Yeah. There's a ton that you just mentioned that was great there, along everything you just mentioned. I think it reminds me of, and I'm forgetting who told me this, but this is like a few years ago. I was having a conversation with somebody who was raising capital. I'll call it at scale. They were raising 8 figures a year. They were JVing with many other investors, and their focus within the overall ecosystem was we raise capital for other people, and picking their brain on basically asking them the same question that I just asked you, like, where do I start? Because I'm trying to start going down this road. And the phrase they used that was a great mental reframe for me was, you have to get out of the mindset of, how do I raise money from this individual, or how do I speak to more investors, and into, how do I build a system that allows me to speak to more investors, right? And it's less about, how do I get this person's email on my list, or how do I get investors' emails on my list? It's how do you build a system that allows you to get, and it all came back to systems, right? It all came back to, how do you build the engine? How do you build the funnel? How do you build the system? And I think once you start thinking about that, it changes how you actually solve the problem, or at least how you approach the solution of the problem, which is, I need to do all of these things that allows me to become a magnet for a lot of this, versus me just trying to go out there and have these conversations with people on one-off basis, and trying to piece together money for a particular raise. And I think it's oftentimes the same thing with deal flow as well, just on the actual deal side, trying to find compelling opportunities. You got to build a system for people to come to you with their opportunities, whether it's a JV partner or a broker or somebody else, a wholesaler, if you're out there trying to flip houses. And it kind of changes the calculus of how you approach that. And I think a lot of people will probably be like, Michael just mentioned a lot of stuff there, and so I'm a little intimidated by all the stuff I got to do. It's really easy to just start sending an email every month, right? Like, to start at a very JV level of, I'm going to send a newsletter on a monthly basis to all the folks on my list who I think are passive investors. And once you start at least building the muscle of going down that road a little bit, it makes it a lot easier to actually start scaling out the platform. A question off of that, and this is a selfish one for me, but I'm curious, is there any components of the content creation landscape, or the marketing landscape, or however we want to define it, landscape, that you're spending a little bit more time on right now, that you see a little bit more opportunity in terms of getting emails on a list, getting eyeballs, et cetera?
The answer is yes, but what I'm about to talk about is a very advanced strategy. There's like step 11. Okay, so we're getting a lot into paid traffic. Paid traffic is extremely expensive, and you need a mechanism to finance that spend and convert it into actual investors. The problem with that business model is, even if I get a lead right now, okay, and I don't have a deal now, I might have a deal in 3 or 4 months or so, right? Then that investor turns into acquisition dollars, which actually I can use to offset my costs with. But a good number of them don't invest in the first deal till they watch you for a little while. So they might invest on the second deal or even the third deal. Now, you only get paid when they invest via acquisition fees. That's the only way you can monetize it, right? So if I'm selling you a $30,000 program, right, that's different, because when you come on, I can immediately pay my ad spend. And so financing this is tricky. Also, you need to be able to have someone to answer the phones to actually sell them and get them to invest. So you have to have a lot more infrastructure. But big advantage of that is it's very scalable, because if I want to add 100 accredited investors on my list, it's just a matter of spending enough money to get them on my list. And so it's very scalable. If you put out content, you can put out more content, and it's a very tedious way to scale. With paid traffic, all I got to do is spend more money. And the trick there is getting an ROI from it. But it does sound like very overwhelming. Back to your original point, you got to do one thing after another. So you get, it's kind of like these spinning plates. You get one plate spinning, right? The biggest thing is getting your marketing platform built. This is the lead capturing, the lead magnet I talked about, the automations. That's number one, because otherwise you can't capture any leads. And then number two is to pick some amount of content. Email is a great way to start. Start getting into the habit of sending out an email on ideally a weekly basis. And then you see where else you're going to go. Where are you going to go to generate leads? And you might hire VA to get you on podcasts. It's the fastest way to reach a larger audience. Or you might become active on LinkedIn or Instagram or something like that. And you're constantly referencing your lead magnet, and you get that play going, right? You get that play going. You kind of create a system for it. Maybe you outsource it somehow, and then you get another plate up. And so the more you do, the more plates you have spinning, and the more lead flow you're getting or leads you're going. So it's a kind of a sequential thing, getting it up and running, and then finding another lead generation mechanism.
100%. Yeah. And even if you're not in a position to spend money on paid ads, which 99% of the people listening to this won't be, right? I think it's, the 1%, hey, maybe you're taking something from this and this is an opportunity for you to further scale your business. The challenge being, as you mentioned, you have to have your nurturing dialed in, right? From the day that they give you their email or get on the phone with you to the day that they invest, a lot has to happen, and it has to happen correctly for you to not lose that person in the, kind of in your email list, and to make sure that they're nurtured all the way to the day that you have that deal or that second or third deal, as you mentioned, right? Where you actually convert them into a true investor. But even if you're not doing paid traffic, the concept is still the same, right? You want to get your channel down, you want to get your lead magnet down, and you want to go deep and really develop some level of a presence or expertise over that particular channel, so that that's a reliable source of emails and investor leads before you then go to the next one. At least that's my 2 cents, right? And for us, that was Instagram when I started trying to raise money. And I chose Instagram because I had a personal Instagram. I was like, I spend time on this platform. This will be an easy thing to do. We operate everything that we raise capital for. I'm in there, taking videos of the units. It can go on Instagram. That's really easy. And after we started to develop a following there, it's like, let's try LinkedIn. I'll start posting on LinkedIn a little bit more frequently. And as we've expanded the purview in terms of what we're looking to focus on from a channel standpoint, it's been very intentional with understanding that we still have to have all the nurturing behind the scenes down, or else we're dropping stuff in the top of the funnel that doesn't matter. And I think that's really important with trying to build out a platform of which you're pulling investors to you, is that it's one thing to get the email, that's great, but you have to take them from day 1 to day 180, day 365 before they actually become an investor. Then you also have to have deal flow behind the scenes that you're raising for to not lose them as well, which is an entirely different part of this conversation, I guess. Okay, before we wrap up the show here, I got to ask you, because you were around in 08, you've been investing for a long time now, in terms of post 08 buying multifamily. No one has a crystal ball, and we all know that none of this means anything. What we say to each other, we're not going to be held liable. But I'm curious as to your feel for what the market does over the next 12 months, or your sense of just where we're going. And it could be contextual based on, hey, Southeast, you guys you have a portfolio in Georgia, and that's kind of the general area within the country that you're looking to do deals, understanding that particular context. What are some underlying assumptions or thoughts that you have around the market that are informing your decision-making around investing right now?
Yeah, I think this is, like I said earlier, going to be one of the best times to buy a multifamily right now, because it's been hammered quite a bit in a variety of ways. And this is compare kind of the environment we're in now versus, say, 2.5 years ago. 2.5 years ago, the height of the market was March of 2020, and the cap rates were the absolute lowest. The leverage you can get was the absolute highest. It was frothy. Everybody was jumping in the game, which is always a sign like, oh my gosh, okay, this is probably a bit overheated. But the outlook back then, first of all, we got very high leverage. When I say leverage, we got, 80% of the purchase price of closing costs and construction costs. Like, why? Very high leverage. Typically, the higher the leverage, the higher the risk is, obviously. Now, for example, we're getting much, much lower leverage. We're getting maybe 75% loan to value with just the purchase price. We're not financing anything else. So comparatively, the leverage is much lower. Therefore, the risk in that respect is lower. Also, the interest rate outlook 2.5 years ago was up. Everybody agreed it was up. So everybody put in, 1% higher, whatever, in their underwriting. Well, at least we did, because interest rates are going up, right? Now the prognosis interest rates are flat to down. That changes a lot of things. Just that prognosis, right? Because obviously interest rates go up, cap rates go up as well. And so prices now are down 30 to 40% of where they were in March of 22. So that means that they're at a discount now. And so we got lower leverage, and therefore our interest rate outlook is flat to down. All those things reduce risk a lot in a big way. And we're getting them at 34% less than they were 2.5 years ago. So to me, it's time to back up the truck and buy as much as you can. The problem is raising capital for it. A lot of people, either they were involved in multifamily and, their distribution stopped, or there's capital calls, or in some cases a complete loss of capital. So they're burned. They're not investing again. And then other people look, read the news and go, oh gosh, that's not good. Right. So it's been a challenge to find capital. And I think the challenge right now is trying to take advantage of this opportunity. It's like people who bought houses in 2008 and 9, back then, the people who were sophisticated and recognized it for what it was, which is an amazing opportunity. And I feel that's kind of where we are right now in the multifamily space.
Yeah, no, I mean, it's, we just raised for a bigger deal relative to the deals that we do in late 2024. So this is 3 months or so ago now. And it was a $5 million raise, which was a bigger raise for us. And yeah, that was challenging. It was way harder than if we had raised for that same deal a year before that, or, much harder than 2 years before that. So we really felt it in the moment, a lot of the challenges around actually getting the deal across the finish line. And I think that's echoed amongst everyone else that I chat with who's currently doing deals and raising money for deals. And I think that New England being a slightly different dynamic than the Southeast, Southwest, where higher supply rents have taken a bit more of a beating, the insurance dynamics, like New England's been a much more resilient market. And I think it has been a little bit easier to raise capital for deals up there because we haven't had the same fundamental distress, or at least at the same level. But yeah, if you're doing deals in the Southeast and that's your target market, I mean, it's a great opportunity given the fact that, yes, you're buying deals at below what they traded for a few years ago, most likely. And you're also buying at a point in time where a lot of the supply, just relatively speaking, in that broad general area is going to be coming, there's going to be less supply over the next couple of years, right? So I think it's a safe assumption to make that rents are going to rebound a little bit more over the next couple of years in most of those markets, right? Which is a pretty commonly stated opinion from all the folks who are much smarter than I am. But it's important to take advantage of that opportunity in the moment now. And I think everything that we just talked about over the last 15 minutes about raising capital and building that infrastructure, like now is the time to spend a lot of time trying to do that, right? Because capital is becoming much more of a constraint than it was really from, at least since I've been in this 2016 to 2022, March of 22, as you mentioned, being kind of that date where interest rates started to go up and the market started to adjust. So if you're able to raise money and you're spending time building it out and you're building out your platform and you're able to raise capital, that's just real competitive advantage right now. And it's important to take advantage of that. So I think everything you mentioned is important for folks to walk away with and really understand. That being said, Michael, this has been a great episode. Where can folks learn more about you, learn more about your business, and reach out to you if they want to get in touch?
Yeah, if they want to learn more about syndications, we actually have a free mini course, 45 minutes long. It's called Apartments 101, and it's on apartments101.co.co. So if you want to learn more about syndications and raising capital, that's a great place to start.
Love it. Appreciate it, Michael. This has been great. I'll throw that in the show notes, and thanks again for the time.
Excellent. Great being here.
If you enjoy this episode, please consider leaving the podcast a rating and a review. And if you think somebody in your network would enjoy this episode, please consider actually sharing it with them and sending it directly to them. That's the only way we grow this show, is by organic growth. So if you have somebody in your world who you think would learn something from this episode or the podcast in general, text it to them, email it to them, share it with them in some other way, and it would be much appreciated.